Welcome to OpalesqueTV. Today I'm in New York and I have with me today Peter Kellner. He is the founder, the chairman and the CEO of Richmond Global Compass. Now as a start, Peter, tell us a bit of your background and how you got started with ESG.
I first got involved with ESG and sustainability through my lifelong mentor, a man named Bill Drayton. He's the founder of Ashoka, which is the largest organization globally of social entrepreneurs. And I met Bill when I was at Princeton in college. And Bill has been responsible for creating some of the most impactful social organizations around the world, like Teach for America and City Year. He inspired the founders. And he inspired me to try to live a purposeful life. I knew I always wanted to be in finance, but I also knew, following him, that I wanted to affect change. And so right after college, I went to Hungary, to Central Europe, which is where my family originally is from, and I was on a Fulbright scholarship. And I was struck by the state of the environment and the way the Soviets had left Hungary, which was very devastated. And so I set up an environmental policy organization there that I modeled on the Natural Resource Defense Council, which is an organization that I followed when I was a teenager in the United States. It's a big, very important organization. And I was able to bring together Hungary's top scientists, journalists, economists, lawyers, to do interdisciplinary reform of the environment and the transition to a market economy. And we ended up actually writing, as an organization, the approximation program for Hungary to ascend to the European Union. And today, about 26 years later, my organization is perhaps the most influential organization in Central Europe, training judges, prosecutors, writing laws. It's global, it works with the World Resources Institute and others. And I'm still involved with it, I still contribute to it. But that was my major first involvement in sustainability. My second one was also guided by Bill Drayton. I traveled with Bill around the world to many places after college, specifically Latin America, although his organization is all over the continents, many continents. And I developed an interest in their model to identify social entrepreneurs who would have a high impact. And I got the idea, because I was business-minded, well, why couldn't you do this to find high-impact business entrepreneurs in the emerging world, to have entrepreneurs drive development? Because it was clear to me from my work at undergraduate and just living abroad, as I had been doing in Central Europe and Russia, that entrepreneurs were going to be solving the problems in the emerging world. And back in the 90s, the emerging world was truly emerging, right? You saw a massive growth in the middle class across the board. And a lot of it was driven by, obviously, the internet and this surge in technology. I co-founded this organization, Endeavor, with a woman who at the time was working for Bill Drayton at Ashoka. And I spent years, actually, I left graduate school, because I'd returned to graduate school, to build that organization on the ground in Latin America, and then I helped build it into the Middle East and ultimately into the United States. But my agreement with my co-founder was that I would go on to a career in finance and entrepreneurship, be involved with the organization at the board level, and I've been on the boards of Chile and the Global Board and Jordan and Louisville and Miami and elsewhere. The organization's now in 33 countries around the world, and doing some miraculous stuff in terms of the entrepreneurs it supports. Last year, those entrepreneurs generated $16 billion in revenues and over 1 million in jobs. So it's a significant organization, Endeavor. So that's my background in sustainability. For Endeavor, it's really wealth and job creation as sustainability. For my Hungarian organization, which I see as more of a actually regional and even sometimes global organization, it's truly an organization focused on the environment. So my day job for the last 2 decades since college has been venture capital and entrepreneurship. I've built some companies, but primarily I've been an investor in some really wonderful companies in the early stages. Companies like Salesforce, today companies like Data and others. And I've always loved to work with entrepreneurs. And my specialty has always been financial services, what we call FinTech. And then in the last 15 years, I've been focused on data science. And this was before data science was the headline every day, machine learning. Because of my passion for sustainability, I had the idea many years ago to see if I could find see if I could figure out a methodology to use data science to identify what we call material, environmental, social, and governance metrics that you could then apply to asset classes to generate alpha and also minimize risks and liabilities when you were doing your financial analysis. And this was of public securities, because my world has been private securities. But I thought, you know, when you look at the world of sustainability and investing today, it's largely private. 95% of it is private. It's slightly less than $1 trillion annually. If you look at the world of public investment in sustainability, it's only 4 to 5%. But that market is 180 trillion. And that's net of derivatives and OTC, another 700 trillion plus. So there's this disequilibrium, if you will, of where you can have a massive leverage in the public markets, but yet it's barely penetrated. So I wanted to figure out a strategy to penetrate those massive markets with the most impactful strategy I could think of, and using machine learning, which is data science, and, to identify ESG metrics. So let me pull that all together for you. ESG metrics today, in 2018, are terrible. Okay, they are self-reported by companies. They're non-periodic. The time series is generally not particularly well put together. It's not well weighted. So the metrics providers that we have today don't have particularly good information. So if you're going to claim that you can use ESG metrics to identify alpha in your investments, and let's just say in corporate only, you know, that's not a credible claim. Unless, which was my hypothesis and which has proved out since we started trading, you can use data science to identify that material ESG metric. And material metrics are non-financial and sometimes financial metrics that affect financial performance. So if a corporation does a 10K run on a weekend for its employees, they may contribute that toward their ESG metrics that they're claiming to do. However, that's not really impacting, right? That's great for culture, that's maybe good for the brand in some small way. But if the same company has, let's say it's a bank and it has 10% of its real estate portfolio in the US in recurring flood zones, well, that's a material ESG metric. But most financial analysts are not looking at those particular metrics. They're not looking at those, you know, off-balance sheet items. But they are incredibly important in the generation of alpha, which has been proven out academically by George Serafeim at Harvard Business School, who's also on our board of advisors at our fund, where he showed that if you use a materiality lens when looking at ESG, you can generate more than 6% in additional alpha. And again, minimize your downside because you're going to be looking at liabilities, regulatory concerns that otherwise you just would not be looking at. And so I brought a couple different things together. I looked at this disequilibrium in market size and the penetration by both private and public sustainable initiatives and said the public sector, the public securities area is where we need to have emphasis now if we're going to have any chance of turning back the tide of climate change. Secondly, what is the most interesting, largest, sizable strategy I could pursue? All strategies today pursuing ESG in the public markets are predominantly, not all, but predominantly long only, maybe with a little credit. I went out and on my own, did a data science study in 2014 into 2015 and looked at securities in Western Europe and the United States, as well as sovereign securities, to see if we could, using machine learning, identify alpha. The results were stunning in terms of the p-values and the correlations, the Sharpe ratios. And we were able to show that you could validate, that you could find material ESG, both in corporate as well as sovereign categories. That got me terribly excited. Yeah. So we started a multi-asset strategy. And what's very exciting about that is our goal is to deliver superior performance, which we've been doing. However, we do that through the integration of material ESG metrics, right? So you're accomplishing two ends. You're not sacrificing performance to get to a contribution to planetary sustainability. You're actually using the very same mechanisms that you need to ensure planetary sustainability to generate superior performance. So it's a beautiful business model. And you're also approaching the gigantic public markets with a strategy that has no limit on your AUM, on your assets under management, right? The only limitation you have is your rate of growth. If you're a long-only strategy, and there's some wonderful ones out there, you actually are going to be limited in how sizable you can be because markets are only so shallow, or so deep, I should say. So we have this strategy. We look across the world. We look at every asset class. We're able, through our machine learning platform that we've spent a lot of money developing, a substantial proprietary platform that both cleans data sets that are out there that are already existing, generates new data sets, new algorithms. We use that to provide our traders information to be more intelligent when they're making a decision about an asset and how ESG, material ESG, relates to that asset. Because we're not a quant fund, and we don't want to be confused for one. A quant fund is a very different animal. We are using quantitative technologies to augment our knowledge of trading, so human beings can actually carry out those functions. And I don't really think there's a way you could ever use 100% machine learning or AI to find ESG, because at least 20% of ESG metrics are very qualitative, and they require that kind of sourcing. So if I have to put a ribbon around it, right, you have the recognition that if we're going to make real change, we have to take on the global capital markets, okay? And we have to do so in a way where we can attract investors to the idea, because we can generate superior performance. And we can do that by using the methodologies of integrated ESG investing, because it's been proven that material ESG metrics generate alpha and limit your liabilities.
So Peter, this is fascinating, because I see that with your methodology, you're actually addressing some of the structural problems that I think this industry really has. So tell me more about your process. And also, is this a form of impact investing, or how do you differentiate yourself from impact investing?
Well, first, I should point out that impact investing is an asset class. ESG investing, integrating ESG into your financial analysis, is a methodology, which happens, again, to create alpha and mitigate your liabilities. So they're entirely separate. Our strategy is not impact investing, which, as you know, runs a spectrum from purely philanthropic to seeking market returns, but always with a social end in mind. So we are different in that we actually use the benefits of contributing to planetary sustainability through identifying these key ESG metrics that go into our financial analysis that produce superior returns. So it's a very different proposition. We're not sacrificing in any way return for social good. We're augmenting return and social good. But what we do is not within an asset class. Structural challenges that exist today have to do primarily with the research, with the information available, which is not standardized. Like I said, it's non-periodic, it's it's self-reported, it's very bad. And so that's one of the primary issues we have. And there are also people who are very much in disagreement over what are the actual material metrics for a given asset class. So there's a lot of disagreement, which really is based around the lack of standardization. So that's something that has to evolve in the market. We feel we address that through the development of our proprietary technology, because what it allows us to do is to find that needle in the haystack, to find those typically 4 to 6 material metrics, ESG metrics, that apply to a corporate or sovereign asset. And in doing so, we can be consistent, so we can contribute to the process of standardization across the industry. We can identify a line of sight from A to B that our identification of that particular metric produces that alpha, okay, and that change. It's highly measurable, and measurement, again, is also a structural challenge in this industry. In fact, it's a challenge across all of impact investing and integrated ESG investment. So we're addressing these through machine learning and through also the combination of our technology with our team. And I should make a point about the strength of our team. They are fantastic. Every member of our team is certified in the FSA, which is the sustainability accreditation that's equivalent to the CFA. And so every member of our team has taken the level 1 and level 2 FSA, which is under SASB, which is started by Michael Bloomberg. And SASB is like FASB, but for the sustainability sector. And all our team members, risk traders, have deep knowledge of ESG through having gone through this accreditation. So it's not like we have our environmental people over here who may have studied environmental science but have no financial background, and they integrate with our trading team over here who are really excellent traders but don't really understand ESG, and they come together and figure things out. No, we have an integrated team that is profoundly good at what they do in financial analysis and investing, but they also have very deep backgrounds in ESG. So we're highly differentiated along many aspects of the spectrum in fund management. One is we are, to our knowledge, the first to create a global ESG multi asset fund. The second is that we're using proprietary machine learning that we've developing with a great team of data scientists to identify material ESG. Those, again, ESG factors that affect financial performance and drive alpha and minimize liabilities. We are also using a hybrid, which is we are integrating exceptionally qualified teams with our technology. And that is something that very few firms are doing. So these are the things that I believe differentiate us from other funds right now. And I encourage other funds to get into our business, frankly, because that's how we're going to change the world. But we don't really fear competition, if I were to say something like that, because we've already built a very deep moat in terms of our understanding of sustainability and the appropriate metrics and our technology, which enables us to do that. So this is a very, very differentiated product and strategy, if you will. And I believe from a vantage point purely of not just the superior returns that it gives an investor, it's also very needed. So, but we're not our appeal is not to your heartstrings. Our appeal is to your rationality, which is, look, we have this is the mega trend of the 21st century, sustainability. Okay, we have a big challenge. We are headed toward a cliff. Now, how are we going to address that? My view is the capital markets are the solution. I've had a history throughout my life of believing that capitalism can drive massive change. And so that's Endeavor, for example, my organization I co-founded that I talked about earlier. In the same way, I believe capital markets are likely give us our highest probability of a course correction in environmental degradation. Now, that's not to say governments and NGOs aren't important. They're very important. But capital markets have not been tapped yet to do this work. And yet they're so sizable and they're so influential. And so we are very differentiated in that we're really the first out of the gate. We are trying to be very intelligent about our application of analysis in cleaning up this messy ESG environment, these metrics, and applying them in a very intelligent way through both the technical application, the human application, and then possessing an enormous palette of tools with which to invest, right, across the world in different nations and different sectors and categories. It's just, it's a beautiful strategy for us because, again, you are using the very same techniques that make for a better world to generate alpha. At the same time, you're never going to run out of ideas. I mean, you know, in the world of hedge funds and finance, there's always often the complaint that people run out of ideas and their funds close down. This strategy is a gift. There's always going to be innumerable ideas and strategies you can pursue, whether it's in green bonds and real estate, or in carbon, or in better supply chain, or in different asset classes. You can apply this to currencies just as you can apply this to equities. It's truly amazing. So we're never going to run out of ideas to generate superior performance. And we're always going to be doing that through these mechanisms that contribute to a better planet. And that, to me, feels really good. So despite all the feel-good aspects of it, it's really critically important to understand that the strategy is not based in some philosophy or moralistic point of view. It's based in empirical research. Okay? I mean, as an example, again, Professor Serafeim, George Serafeim, who's on our advisory board from Harvard Business School, is the world's leading ESG analytics professor. And he had a paper published in 2015 called The First Evidence of Materiality, where, again, as I noted, he demonstrated statistically that you can increase alpha by focusing on material ESG in your corporate security selection. This is empirical. And then I put a lot of research into my own study, where we worked with a very well-known data science firm for over 12 months to see that this was applicable not just to corporate equities and debt, but also to sovereign asset classes. So this is an empirically based strategy. It works. It's credible. And I believe our returns reflect that. I mean, since inception, 15 months ago, we beat our benchmark in our first year by 10 points. And we beat the longest bull run in history in equities by 4 points. So we're doing something correct here. And again, it's not categorically, morally imperative. It's based on empirical research.
So Peter, looking forward, how do you see this ESG space further develop?
So looking forward and into the development of ESG and integrated investing, we are very confident that within about 15 years, the integration of ESG into financial analysis is going to be normal. Okay, today it's not, and there's a lot of resistance to it. There's a lot of short-termism in the marketplace amongst CEOs that look at quarterly earnings calls. There's a lot of pressure on the very things that prevent an ability for a long bias. And when you're trying to invest in sustainable assets and apply a sustainability lens, you need a longer period to accomplish that. Not infinite, but you need 3 to 5 years to start implementing your strategies and start to see, for example, the companies you're invested in start to substantiate the business plans that they've created around sustainability. But the other remarkable thing about this is it's standard in the world of hedge funds for managers to pile into ideas and for those returns to be arbitraged away as everybody piles in and commodifies it. In this particular area, the opportunity for return seems to me to be infinite, because the possibilities for creative investment are infinite. And so we've just begun. And the more people who pile in, so to speak, the better we are all, because it validates the space. There's still a lot of people, particularly in the US versus Europe, who are questioning ESG and its relevance. Whereas in Europe, and this is actually a study that was done by Professor Serafeim at Harvard Business School, where he looked at asset managers in the US and Europe, and he very definitively proved that in Europe, asset managers recognize ESG as both something that enhances return and mitigates risk. So when they get asked the question, do you contemplate ESG, they sort of say, why are you asking the question? Of course we do. In the US, the managers in his study, and these managers were managing tens of billions of AUM, said, in large measure, we approach ESG when our limited partners ask us to do so. So they don't really recognize the intrinsic value. So we have a ways to go. But again, the opportunity is that the opportunity for ideas when you are integrating ESG across asset classes is infinite. You can't crowd into this idea and have returns arbitraged away. It just will not happen.
Peter, tell me about your portfolio construction.
So portfolio construction is actually designed by my partner and CIO, Decio Nascimento. Decio is remarkable. We met completely fortuitously through a mutual friend at Paulson. Decio had started his career at Goldman Sachs trading derivatives when he was putting himself through the London School of Economics. After that, he went to Brazil, he's Brazilian originally, and worked for Louis Stuberger at the Verge Fund, which is one of the most successful macro funds in the world. And he was literally Louis's right-hand person, 24/7. And that's where he learned his trade. He learned how to sort of think, the philosophy of his approach to investing. He then went to New York, came to New York. He wanted to move to New York. Louis did not at the time want to set up an office in New York. And he joined 3G Capital, which is a well-known, successful firm. The owners, Anheuser-Busch, they acquired Heinz and Kraft and Hortons and others. Very, very successful investors. There he ran and helped to run their liquid strategy. So he was responsible for macro. Subsequently, Decio took a sabbatical because he'd literally been working since he was 18. And went around. He's a mountain climber. He's climbed a number of different mountains, and came back after a year to New York, which is when I met him. And I'd literally just finished that proprietary study I talked about, data science study that corroborated my thesis about materiality and ESG metrics as applied to corporate and sovereign asset classes. And I met him literally 2 weeks after I completed that. And Decio had offers from significant macro funds, but he wanted to do something impactful. And he told me, in the year off, I had been thinking about it, but I couldn't figure out a way to use my skills to do something impactful. And I said, well, here's an idea. Why don't you join me, and we can take your deep skills in multi-asset fund management and combine them with ESG. And he didn't know what ESG was. And I was so impressed by him. He dove in. Before he joined me, he said, I need to research this. So he looked at first the study that I had done, which was very mathematical, and he's a mathematician. And secondly, he came back to me. We had many meetings before we joined up together. And one meeting he came to me and said, I've been doing Fed research, Chicago research on the Chicago Fed going back to the 70s. And they've been talking about this. And this is the Chicago Fed. I mean, these are the neoclassical, economists. And so he said, this is real. And I said, yeah, it's real. So he joined me, and together we set the firm up and really focused on building something institutional from the get-go. So, we have an institutional grade back office today, risk, compliance, cybersecurity, you name it. And Decio took over not just the portfolio construction, but building the team. He was part of the first cohort of the FSA accreditation. He was in the first class to qualify, and he made sure that everybody we hired thereafter in the firm got that accreditation. And more than that, he went and took the MBA in Sustainable Finance at Yale, which is taught partially by one of our advisory board members, Dan Esty, who was also my professor at Yale Law School. And Dan is one of the foremost well-known professors of environmental law in the world, frankly. And so Dan's on our advisory board. I should make mention of our advisory board too. Dan's on it. George Serafeim, as I mentioned, is also on it at Harvard. Decio developed has a very keen relationship with him as well, and they work on all kinds of ideas and white papers. I think Decio is speaking with Dan or George on a weekly basis, so it's very integrated. And also with Erik Allen, who's our AI director, advisory board director from MIT. We're speaking with Erik on a weekly basis as well, as we iterate through our machine learning platform. Decio and I began to build that machine learning platform from the get-go. It was one of the first things we did, was start to prove out that. And we did it through phases with a team of 7 full-time data scientists who are on the effort. And we had the first 2 phases were designed to create credible data that we could begin where we could begin to focus on the 3rd phase, which is actionable data. So in the first 2 phases, we were able to do all the scrubbing of data sets, the creation of new data, and all the interpolation that I referenced previously to identify those critical material ESG factors. We're now in that 3rd phase where we're developing what we have called the Compass Materiality Dashboard. This is, to my knowledge, the first dashboard of its kind with respect to ESG metrics in public trading and public securities. It will enable us to identify each of those 4 to 6 key material ESG metrics, ESG, for every asset class that we look at. That's a stunning breakthrough, okay, in investment intelligence. And so Decio's been managing that process. I've been helping out with that. And so, he's been contributing massively. And of course, he is in charge of portfolio construction, which is all about asset allocation. And our performance, again, has been very, very strong. And the way it begins, the way his process works is looking. It's a very top-down traditional approach where we're looking at the big blocks, ECB, BOJ, China, US, the Fed, most importantly, and when they set the interest rates, it affects everybody else. And then we look at how those affect regions around the world, nations, and then we drill down from nations to sectors, and then down to specific companies. At every level of our analysis, from the macro, if you will, to the idiosyncratic, we're also integrating ESG. So when we're looking at sovereigns, for example, beyond the macroeconomic work that we do to establish what's going to happen in the world, are there going to be rate hikes, and et cetera, we're also looking at what I call the health and wealth of nations. And for that, we're using indices that are non-GDP focused. So we use GDP focused measurement, very traditional stuff that I mentioned, but we're also using non-traditional GDP indices. And the most important one that we're using is called the Social Progress Imperative, founded by our colleague Michael Green. And our fund has an actual formal collaboration with SPI, it's called. And what they do is they have developed these comprehensive indexes across the world that measure nations and down to the municipality level for children's, for education, primary, secondary, higher ed, access to, right? Corruption levels, women's rights, environmental degradation. The list goes on and on and on. But these are non-standard, they're not standard GDP measures. But they give you a very, very crisp view of the health of a particular nation. And if you combine that with the traditional monetary indicators, you get a very rich picture of a country when you're looking at it from the ESG perspective. So that's the portfolio construction, pretty much traditional top-down construction. And then there is a more technical management of the cash book and the trade book that we engage in. The cash book, for example, will have an expected yield, say 10%. And that's going to be dividends and capital appreciation, right? Equities and debt. The trade book will be derivatives. So we'll have our expected yield in the cash book, and that way we'll size the trade book. Let's say it's 6 or 8%. In the trade book, we will put on asymmetric trades, 3 to 1, 5 to 1, 10 to 1. And based on the performance of those trades, we can have very large payouts if we just hit 2 or 3 of them. And it's also a way for us to invest without having too much cash exposure. We have a long-term horizon and we try to have very low churn in our portfolio. So when Decio and I came together in 2016, I remember him saying to me, I anticipate 4 rate hikes by the end of 2018 and a meltdown in the emerging markets. So I think we should position the portfolio for that, which is precisely what played out, right? By the way, so our portfolio right now, looking at the volatility which we're enduring right now, which is, by the way, great for us, is something we are completely protected against, and actually is something that's going to allow us to generate a very significant return. So we reduced our equities exposure a long time ago, to the point where friends of ours were saying, "Are you crazy? This is this massive bull run. Why aren't you taking more advantage of it?" And we were we didn't want to get greedy. We were making enough money with our exposure to equities, but we had our stops, and we felt comfortable with those. And frankly, they saved us in some instances. That's how our portfolio construction has protected us and plays out. And right now, we're not changing much because we are looking out at the world right now, and we think a correction is likely coming at some point. And but we've had that position for some time. We've just managed our exposure in a way that is pragmatic, right? So it's not that we didn't take advantage of the equities rally. We just maintained enough exposure to make money, but not lay it all out there and have it blow up.